The Institute for Supply Management's Manufacturing Report. The ISM Manufacturing Report is a survey of the manufacturing sector that is used to gauge both the strength of the manufacturing sector as well as the economy in general. The ISM Manufacturing Report is issued monthly by the Institute of Supply Management on the first business day after the month being reported, making it the first monthly report on the economy. Each month, the ISM sends out a survey to about 400 companies in about 20 different manufacturing sectors, inquiring on the activity for the month. The survey asks managers to assess the levels of new orders, production levels, inventory levels, supplier deliveries, employment, commodity prices, customer inventories, and more. For each question, the managers are asked to select one of three choices: better, same, or worse. The responses to the survey are used to generate the ISM Manufacturing Report. Looking at the report overview, the first part contains the Purchasing Manager's Index Number, and then the index number for each of the subcategories used to calculate out the total Purchasing Manager Index. Listed is the current index number for each category, the previous month's index number for each category, and then the percent of change for 1 month. Then there's the direction that category is going, the rate of change for that direction, and the number of months it has been moving into that direction. On the bottom is an assessment of the entire manufacturing sector as well as the overall economy in general. There is also a section for commodity prices and for responder comments. In the following section, the report expands the subcategories from the first section to include much more detail, including identifying which sectors reported better or worse results for the category. For each section of the report, an index number between 0 and 100 is generated. It is calculated by taking the percentage of those reporting an increase in activity and adding to it half of the percentage of those reporting no increase in activity. If the response was worse, it was not counted. For example, if 40% of the responders report an increase in activity, 40% report no change, and 20% report worse, the PMI will be 40 plus half of the 40 that reported no increase for a total PMI of 60. A score of 100 means all responses reported better. A score of 0 means all responses reported worse. A score of 50 means there was an equal number of better and worse responses. The most important component of the entire report is the Purchasing Manager's Index, or PMI. The Purchasing Manager's Index is a weighted index number generated from the answers to the first 5 sections of the survey: the level of new orders, production levels, employment, supplier deliveries, and inventory levels. A PMI score above 50 means that both manufacturing as well as the entire economy is growing. Less than the low 40s means that both manufacturing and the entire economy is contracting and probably in a recession. And below 50, but above the low 40s, somewhere in the middle between the two, means that manufacturing is contracting, but the overall economy might still be growing. Equally as important as the index number is the rate of change and direction from the previous months. For instance, if the current index number is 52, yet the previous 2 months before that the numbers were in the 60s, then the 52 reading would be considered bad news. Remember that this report is used to help a trader try and predict where the economy is going. By looking at the rate of change for each month, one can get an idea of which way the numbers are heading. In general, an increase in PMI number is seen as a good sign for the economy because it shows that demand is increasing. However, it depends on where the economy lies on the business cycle. If the GDP is declining near the bottom of the cycle or on the beginning of the uptrend, an increase in demand shows that the economy is improving. However, if the GDP is already near the top of the cycle, an increase in demand could be a signal that inflation is increasing and efforts may be taken to slow down the economy, such as raising interest rates. In other words, if the economy is already booming, a report that says it's growing bigger could be considered bad news. Another important section to monitor is the new order section. The new order section can be used to gauge if the economy is expanding or contracting, and it is an excellent indicator for predicting short-term changes in GDP. The new order section could be used for gauging future employment levels as well. If the level of new orders is rising, companies will need to hire more employees to build the goods. If the level is dropping, employers may find they need to reduce the number of employees they have. There's also an employment index, which tracks current employment. So you have the employment index, which indicates the current employment situation, and the new orders index, which shows a slightly longer view of the employment situation. The price index section tracks the prices manufacturers pay for materials. If the index number is going up, it means that material costs are increasing, making this an excellent leading inflation indicator. The supplier's delivery index should also be closely monitored. The supplier deliveries index tracks the delivery times from manufacturers' suppliers. If the index number is increasing, it means that manufacturers are waiting longer to receive materials. This shows that demand for supplies is increasing and could indicate that inflation is on the horizon. There is also a special section for commodities. This section specifically names which commodities are up or down in price and which are in short supply. In addition to being an excellent short-term indicator for the prices of the specific commodities named, this section is also a leading indicator of longer-term inflation, since these are the very basic raw materials of things that are produced. So you have the price index to reflect where inflation is now, the supplier delivery index to show where inflation is heading, and the commodities section for a glimpse into even longer-term inflation. Two more sections worth mentioning are the inventories and customer inventories indexes. When the index numbers in these sections are going up, it means that inventory levels are increasing. Increasing inventory levels could be a sign that demand is going down. Because of this, it could also be an indicator that unemployment may soon rise. When the inventory levels go down, it means that demand is increasing. This means that GDP is growing and unemployment levels should soon begin to decline. However, it may also mean that inflation will soon increase. So there you have it, the Institute for Supply Management's Manufacturing Report, one of the bigger economic releases. I've only touched on the many uses for this report. It is an excellent tool to help gauge growth, inflation, unemployment, and much more for individual sectors as well as the entire economy. It is also the first monthly economic report released. In the next video, we'll look at a more specific section of manufacturing, durable goods. See you then.